Good morning, everybody. Thank you for joining us today for today's webinar. My name is Amber Hines, and today we're going to be talking about factors to take into consideration when doing Medicaid planning for an individual client that does not have a spouse involved. Again, my name is Amber Hines. I started Ashper to assist advisors and attorneys with pre-planning solutions as well as crisis planning solutions. These are going to be insurance-based solutions. I am insurance licensed in all states, and I also hold my Series 65 license with FINRA. I have been working with elder law and estate planning attorneys for the last 15 years all across the country to assist their clients with Medicaid compliant SPIAs or Medicaid compliant annuities. If you're interested in a copy of the handouts from today's webinar, feel free to download those out of the handouts portion of the GoToWebinar dashboard. Also, if you have any questions throughout today's webinar, feel free to type those into the questions section, and I will be happy to get to as many questions as we can when the webinar is over with today. So today we're going to be talking about crisis planning, specifically Medicaid planning. So if we are looking at planning for an individual client that does not have a spouse involved, there are going to be income and asset limitations for an individual. The income limitations for an individual generally is going to be that their income must be less than their cost of care. There is an exception, and the exception would be if you live in an income cap state, which I'm going to be showing a map later in the slides that will help you to determine if you are in an income cap state. If you do reside in one of those states, the current cap amount is around $23.50 per month that the Medicaid applicant can have without having to have a qualified income trust or a Miller trust. If the client's income exceeds the $23.50, then the qualified income trust or a Miller trust would be required in order for that excess income to go into the trust to then pay the allowable medical expenses to get around that cap amount. Generally, if we're looking at the asset limitation for an individual that does not have a spouse, in most states, the asset limitation is going to be $2,000 or less. This is going to vary by state. Some states like New York, the asset limitation is up around 20,000, but in most states, the cap as far as an allowable asset limitation is going to be right around $2,000. There are other resources that are going to be considered non-countable for Medicaid eligibility purposes. This doesn't necessarily mean that these assets that you're seeing on the screen are going to be exempt from estate recovery though. So when we're talking about an individual client that is trying to qualify for Medicaid, generally their home is going to be an exempt asset if they intend to return to the home or if they're attempting to sell the home. Also, an automobile or vehicle is going to be an exempt asset. Their household goods and personal property, an irrevocable funeral trust or prepaid burial plan. And then in some states, IRAs are exempt for the Medicaid applicant. They're either completely exempt or they can be exempt if the person is receiving their required minimum distribution for IRS purposes or just simply receiving systematic payments out of the IRA. That can also make that account be exempt for Medicaid planning purposes. So if you have a client that has excess assets, we generally look at developing a Medicaid eligibility plan, and that can include increasing or improving non-countable assets, like making improvements to the home, the car, any other non-countable asset that the client would have. They can also purchase prepaid burial policies or a prepaid funeral policy. They can pay off credit cards, mortgages, or other debt that they may have. And if all of those other items have been exhausted, we can then consider purchasing a Medicaid compliant annuity that would comply with the Deficit Reduction Act of 2005. When we look at Medicaid planning with annuities, A Medicaid annuity is always going to be a single premium immediate annuity, not a tax deferred annuity. So a tax deferred annuity is going to be similar to a CD at a local bank where a client is going to surrender a lump sum of money in exchange for a guaranteed interest rate or a guaranteed rate of return or income stream in the future. A tax deferred annuity is always going to have a cash surrender value that the client can have access to, similar to a CD at a bank. So the tax deferred annuity is always going to be considered a countable asset that the client can use for Medicaid planning purposes in order to convert those assets into an income stream. So a tax deferred annuity is going to be considered an available asset for Medicaid planning. So we want to look at using a single premium immediate annuity in order to convert a countable asset into an income stream for Medicaid qualification purposes. As a result of the Deficit Reduction Act of 2005, immediate annuities that are used in Medicaid planning must meet strict requirements. There's hundreds of insurance companies out there that offer single premium immediate annuities, which are simply converting a lump sum of assets into an income stream. But there's less than 10 insurance companies out there that offer a true Medicaid compliant annuity. So if you're working with a local financial advisor and they tell you that they have access to a Medicaid annuity, make sure you are reviewing a copy of that contract so that you see that it has all of the requirements that would be necessary in order for the annuity to work for Medicaid. If you are reviewing an existing contract that a client has or looking at working with somebody to purchase a Medicaid compliant annuity, the 5 requirements that you're seeing on the screen here are the requirements that must be included in an immediate annuity contract in order for the contract to be considered Medicaid compliant. So the annuity must be completely irrevocable. This is not just the income stream that must be irrevocable. This is going to be every aspect of the contract when it comes to the payment date, the payee, who the beneficiary is. It has to be completely irrevocable, meaning that we can't change any aspect of the annuity contract in order for it to comply with Medicaid. We also need a contract that's going to be non-assignable. When we're talking about the contract being non-assignable, we cannot assign a Medicaid compliant annuity contract to a company like JG Wentworth or Peachtree, companies that would buy an immediate annuity on the secondary annuity market. In order for the annuity to be completely non-assignable, it has to have the non-assignable language in it so that no third party would want to purchase the contract from the Medicaid applicant. Also, the annuity must be actuarially sound. The actuarially sound requirement means that the annuity must return the initial principal that is put into the contract within the person's Medicaid life expectancy. It can be structured for a shorter period of time. There are currently 3 states that don't allow for a shorter annuity term than the person's Medicaid life expectancy, which we'll talk more about later. And then we also must have equal payments on the annuity, meaning that we can't have any balloon payments. So prior to the Deficit Reduction Act, we could use a balloon style annuity, which would essentially backload the annuity contract. So the client would receive a very large lump sum as the final payment. We can no longer do that after the DRA was passed. And then also the state Medicaid agency must be listed as a beneficiary on the annuity contract. There are certain exceptions to this rule. If the Medicaid applicant would have a minor or a disabled child, they would be able to be listed as a beneficiary before the state Medicaid agency. So if we're looking at the Medicaid planning opportunities that would involve a Medicaid compliant annuity when we have a single applicant that does not have a spouse, we're generally looking at 2 different options for a client. The first is going to be a gift and annuity plan, and the second is going to be a standalone Medicaid compliant annuity plan without a gift involved. We're going to look at a case study example of Mary, who is a single individual. She is 75 years of age, and after living at home with dementia for years, she's now in need of nursing home care. Mary's family believes that she could live for another 10 years in this sort of supported care environment. Her total countable assets are $205,000. This is consisting of all after-tax and non-IRA funds, so money that's sitting in a checking or a savings account. Mary has monthly income of $2,000 a month from her Social Security benefit and a pension. Her private pay rate at the nursing home is going to be $10,000 per month. So if we look at what Mary's monthly income shortfall or deficit is, she is currently being charged $10,000 per month for her care, but she only has monthly income of $2,000 per month. So we know that on a monthly basis, she is going to be short $8,000 per month from being able to meet her nursing home cost. If Mary does no planning at all, she is going to exhaust her entire life savings of $205,000 in just over 2 years. So that number was determined by just taking the shortfall of $8,000 per month and dividing that by her total countable assets that she would have available to her at $205,000, and we get 25 months in this case. But if you recall, Mary's family believed that she was going to live for many more years, so doing nothing is not going to be a great option for Mary in this case. So our first option would be to use a gift and annuity plan. The goals of a gifting plan is to allow a single Medicaid applicant to make an immediate wealth transfer or gift to his or her intended beneficiaries. And we know, because the Deficit Reduction Act has a 60-month look-back period for gifts or uncompensated transfers, we know we're going to be incurring a penalty period or an ineligibility period as a result of gifting money out of the Medicaid applicant's name. So the second goal would be to obtain Medicaid eligibility after we have incurred that penalty period, which we are aware that the person is going to incur when we develop the plan. So I like to think of a gifting plan as money going into 3 different buckets for a client. So as a result of the Deficit Reduction Act of 2005, in order for a Medicaid penalty period to begin, a Medicaid applicant must be income and asset eligible in order for Medicaid to start that penalty period. So I like to think of 3 different buckets where clients' assets or countable resources would be allocated to. So if we think of most states having a resource limitation or an asset limitation of $2,000 or less, we assume that the client is going to keep just under the $2,000 limit, or if you're in a state that that number is slightly different, we're going to have the client keep just a little bit less than what the actual limitation is. If I'm working in a state that allows a client to keep $2,000 of assets, I usually recommend a number around $1,500 or $1,800 that we would keep. Another portion of the money is going to be gifted, and you're seeing that in the middle of the screen. And then the last portion is going to be used to purchase a Medicaid compliant annuity. So this first step in determining the gift and annuity strategy is going to be to determine the monthly income shortfall. So we already did this where we were determining how much money Mary is short each month from being able to pay her nursing home costs. So her nursing home cost is $10,000 per month. She has monthly income of $2,000. Her shortfall is $8,000 per month. The next step is going to be to determine the burn rate. The burn rate is simply allowing us to determine how much money is going to be gifted and how much money is going to be used to purchase the annuity. So I'm going to add the income shortfall of $8,000 per month to the divestment penalty divisor In this case, I'm working in a state where the divisor is $10,730 per month. And so the burn rate is going to be $18,730.10. The divisor is going to be a number that Medicaid uses to calculate the penalty or ineligibility period. And this is used to divide the gift amount by the penalty divisor. So if we're looking at a client that has gifted already $100,000 and you divide that by your state divisor of $10,730, we're going to determine that that client is going to be ineligible for just around a 10-month period. The penalty divisor is supposed to be the average cost of 1 month in a nursing home in your state. So this number is going to vary pretty drastically depending on where you're located in the country. So a state like Texas, the divisor is around a number of $5,000 per month, whereas a number in a state like Pennsylvania or New Jersey, the cost of care there or 1 month in a nursing home is going to be in excess of $10,000 per month. So some states, the divisor is going to be more accurate as far as what your clients are paying on a monthly basis. In other states, it's low in comparison to what the client will actually pay. You can find the divisor in either your state Medicaid manual or on your state Medicaid department's website. We also have the divisors on our website as well if you're interested in that information. So the third step is going to be to determine what the penalty period is going to be from dividing the spend down amount of $205,000 by the burn rate of $18,730. We determine that the term of this plan is going to be 10.93 months. The gift amount is going to be determined by taking the term of the plan of 11 months, and we're going to multiply that by the divisor of $10,730 to determine that the gift amount is $118,031.10. We now, if we look at the spend down amount of $205,000 that the client had, and we subtract the amount that is going to be gifted of $118,000, we determine that the annuity is going to be purchased for $86,968. This same amount is going to be invested into a Medicaid compliant annuity that's going to be structured over an 11-month period, so that the monthly payout on the 11-month annuity is going to be $7,920 per month. The total payout when we multiply the 11-month time frame by the monthly payment of $79.20 is $87,120 per month. And that's going to be just slightly more than what is invested into the annuity. And that's just representing a small amount of interest that would be paid on the annuity policy. You'll notice that the annuity can only be structured for a whole number of months. So we can't structure the annuity for 10.5 months or 10 3/4 of a month to match a penalty period, because that would result in the annuity having unequal payment. So in this case, my options were to do either a 10-month annuity or an 11-month annuity. The 11-month annuity got us to where we need $800 a month. The total income then follow.
Okay, I called in on my phone, so hopefully you can hear me now. Having some issues with our internet connection, apparently. If somebody can let me, okay, I'm getting a signal that people can hear me now. Sorry about that. So I'll go back just a couple of slides here where we were looking at determining the amount that needs to go into the annuity. I was subtracting the amount that is gifted at $118,000 from the total amount of resources at $205,000 to get the annuity amount at $86,968. I take that amount and invest it into a 11-month annuity and determine that the monthly payout on the 11-month term is $7,920 per month. The total payout is determined by taking the monthly payout of $79.20 and multiplying that by the 11-month time frame to get the total payout of $87,120. This is going to be slightly more than the single premium of $86,968, and that's just representing a small amount of interest that was paid on the annuity contract. You'll note that the annuity can only be structured for a whole number of months. So in this case, I did an 11-month annuity. We could not structure the annuity for a 10.5-month time frame or a 10.75-month time frame because that would result in the annuity not having equal payments. So the annuity must be structured for either a 10-month time frame or an 11-month time frame. During the penalty period, Mary's monthly income is going to be consisting of her Social Security and pension at $2,000 plus her annuity income at $7,920, so that her total income is $9,920 per month. If we subtract Mary's total income of $9,920 from her total cost of care at $10,000 per month, we see that the shortfall is $80 per month. Many people ask the question that why we have to develop, why is the monthly income shortfall necessary? And the answer is that Medicaid must consider the person to be eligible from an income standpoint and from an asset standpoint in order for them to start a penalty period. So if we were to create exactly $8,000 per month in this case of income from the Medicaid compliant annuity, when you submit a Medicaid application and you indicate that you want Medicaid to start the penalty period because we made a gift, then Medicaid is going to say, I'm sorry, Mary already has sufficient income to meet her expenses. So they're not going to start that penalty period, which is why a shortfall is always going to be necessary in order to establish that the person is otherwise eligible for Medicaid, but for the fact that they have made a gift. As far as what the monthly income shortfall is, that really depends on your comfort level and kind of what your state Medicaid agency will look at as far as determining the allowable medical expenses. I usually recommend a shortfall of at least $100 per month, and in some states it can get up to $2,000 per month if we're not confident that all of the medical expenses are going to be considered allowable expenses. So when we look at the economic results of doing the gift and annuity strategy for Mary, we know that she is going to be ineligible for Medicaid for the 11-month time frame. This is the private pay or penalty period based on the $118,000 that was gifted out of her name. But we intentionally set up an 11-month annuity so that she is able to almost meet her monthly expenses during that time frame. So during the 11-month time frame that Mary is going to be required to privately pay, her income is $9,920 per month, leaving her with an $80 a month shortfall. And then in month 12, Mary would be deemed eligible for Medicaid because at that point, the annuity is done paying and the penalty period resulting from making the gift of $118,000 would have expired. The advantages in this case is that we allowed Mary's children to receive an immediate gift amount of $118,000. This is going to be more than 50% of the total assets of $205,000. We're not really concerned about any real significant tax consequences in this case because we assumed that the full $205,000 is going to be consisting of all after-tax money that was sitting in a checking or a savings account. And like I said, Medicaid is going to start paying for Mary's care in month 12. One thing that I would like to point out about the gift amount of $118,000 and this amount being more than 50% of the total assets, a lot of times when we look at doing a gifting plan for an individual client, many people just use round numbers to say that we'll gift 50% of the assets and the other 50% is going to be used to purchase an annuity or to pay during the penalty period. But it doesn't always work out to be an even 50%. I would say that less than 1% of the time it works out where 50% of the assets are actually gifted and the rest of it is used to purchase an annuity. So you actually do have to go through the calculations to figure out how much the client is able to gift versus how much would be used to privately pay. We're going to be talking about the different factors that will increase or decrease the gift amount a little bit later. The disadvantages in this case would be that if Mary does not live through the 11-month private pay period, then she's not really going to receive any economic benefit from Medicaid because Medicaid does not start paying for her care until month 12. So with every case, we're going to consider the person's life expectancy and whether we anticipate them to survive the penalty period or if we anticipate them to predecease that penalty period. If you reside in an income cap state that has a cap amount right now at $2,350, we know in this case that Mary's total income was exceeding that amount. It was $99.20 per month. So if you are in an income cap state, the numbers as far as the gift and annuity plan are not going to change, but the income that is in excess of the $2,350 per month is going to have to flow through a qualified income trust or through a Miller trust before paying the nursing home. That would be a requirement in order to establish that otherwise eligible criteria so that the person has less income than what Medicaid is going to consider in an income cap state of the $2,350. So a Miller trust is going to be an irrevocable income only trust that is going to hold excess income that a Medicaid applicant has, and the only type of resources or income that should be going into this trust is the income that a client has, whether it be income from pensions, Social Security, or from the annuity that the client would have. So resources that the client has or assets that the client has would not go into that trust. It would only be the client's excess income that would flow through a Miller Trust if you live in an income cap state. So on the slide here, you're seeing all the states that are in orange that are considered to be income cap states, that if you were going to do a gift and annuity strategy and the total income exceeds $2,350, we would have to establish a Miller Trust in order to have an allowable income amount in these states. If we look at the parties to Mary's Medicaid compliant annuity, Mary would be the annuity owner, the annuitant, and the payee. The primary beneficiary is going to be the state Medicaid agency, but only to the extent that Medicaid benefits are provided on behalf of Mary. And then the secondary or the contingent beneficiary is going to be a children, a trust, a charity, or whoever Mary wants to name as the remainder beneficiary. Like I said, there are a couple exceptions to the state Medicaid agency being listed as the primary beneficiary. If there is a minor or a disabled child, they can be listed before the state agency as well. So let's assume that Mary passes away 6 months after the Medicaid compliant annuity is purchased. The state Medicaid agency is going to be the primary beneficiary only to the extent that they provide Medicaid benefits on behalf of Mary. Since the annuity is going to be structured for an 11-month time frame, if Mary passes away 6 months into the plan, the state would provide us with a clearance letter indicating that they did not provide any Medicaid benefits to Mary during this time frame, so that the insurance company, after they obtain that clearance letter, can pay out the secondary or contingent beneficiaries, assuming that's going to be Mary's children or whoever she wants to name as the beneficiary. So they would receive the remaining 5 months of payments on the annuity contract. If we assume that Mary passes away 12 months after the annuity is purchased, nothing would happen to the annuity contract because the Medicaid compliant annuity in this case was structured for 11 months. And if Mary passes away 12 months after the annuity is purchased, then the annuity has already expired and there really isn't any need to report this claim to the insurance company because the annuity was done paying out in month 11. The time frame for implementing a gift and annuity strategy, typically we want the client to make a gift, purchase the Medicaid compliant annuity, and apply for Medicaid. This usually happens all in the same month, and we do this in order to establish that the person is otherwise eligible for Medicaid, but for the fact that they have made a gift or a transfer of assets. When Medicaid sees that there is a gift or a transfer that has been made within the last 60 months, they're going to assess a penalty period for the amount that is gifted based on the gift amount is divided by the divestment penalty divisor. We then are going to use the annuity payments to start paying during the penalty period, and after the penalty period is over, then the person is going to be Medicaid eligible and the annuity is also going to be expired at that point as well. If we consider a fact change where we have a cost of care change, in our original example, Mary's cost of care was $10,000 per month. If we instead consider Mary's cost of care increasing up to $14,500, the numbers are going to change based on the increased cost of care. So we're again going to determine the monthly income shortfall by subtracting her monthly income of $2,000 from the cost of care at $14,500. And we now see that the shortfall is $12,500 per month. instead of $8,000 per month. So this tells us that because the shortfall is greater in this case, the annuity amount that is necessary to cover a penalty period is also going to be greater in this fact change. The burn rate in this case is going to be determined by taking the income shortfall of $12,500 and adding the divestment penalty divisor. We're working in the same state at $10,730 per month. So the burn rate is $23,230 per month. The spend down amount is not changing. That's still $205,000. If we divide that by the burn rate of $23,230 per month, we see now that the term of this plan is going to be 8.82 months. So the gift amount in this case now with the increased cost of care is going to be 9 months times the divisor of $10,730. And we see that the gift amount, instead of being $118,000, is going to be $96,570 per month. We see when we subtract the gift amount of $96,570 from the spend down amount of $205,000, that the annuity is going to equal $108,429 per month. This, instead of being structured over an 11-month time frame, we're going to structure this over 9 months. And we see that the monthly payout on the annuity is $12,100 per month, equaling a total payout of $108,900. Again, the annuity can only be structured for a whole number of months. And because the penalty period in this case is going to be a 9-month time frame, we did a 9-month annuity to cover the shortfall during that same penalty period. So the financial impact of the increased cost of care, with Mary's cost of care increasing by $4,500 per month, we see that the gift amount decreases. With the gift amount decreasing, the penalty period is going to decrease as well, because we talked about the penalty period being based on the gift amount and dividing the gift amount by the divestment penalty divisor. So we see that the penalty period is decreasing from 11 months down to 9 months. Because Mary's cost of care is greater each month, the amount that's necessary to fund the Medicaid compliant annuity is greater as well, because the whole purpose of the Medicaid compliant annuity is to provide a guaranteed income stream during the penalty period. So as the client's cost of care increases, the amount that we need to put into the annuity is also going to increase, because they have a higher cost of care need, and that's only going to be supplemented by purchasing a larger annuity contract. So if we look at how the applicant's circumstances are going to impact a gift and annuity plan, obviously a client that has a larger spend down amount, let's just say $500,000, is going to have a longer penalty period, and therefore will need to purchase a larger annuity than a client that only has $100,000 that they need to spend down in order to start a penalty period. Also, if we compare a client that has a higher cost of care, let's just say $10,000 per month, and we compare that to a client that has a lesser cost of care of $5,000 per month, we know that the annuity that's going to be necessary to cover a $10,000 a month cost of care is going to be greater than a client that only has a $5,000 a month cost of care need. Also, a client that has higher monthly income, whether that be through Social Security, pension, or survivor pension, they're going to have to put less money into an annuity than a client that has a low monthly income of, say, $500 per month. If we look at alternatives to a gift and annuity plan, we could consider a gift and promissory note plan or a gift in return, otherwise known as a partial cure. So a gift and promissory note plan is going to be very similar to the gift and annuity plan, but instead of using the annuity, we're going to use a promissory note or a loan instead of the Medicaid compliant annuity. The Medicaid applicant is still going to make a gift, which is going to trigger a penalty period, but instead of using the annuity, they're going to make a loan or establish a note that is going to be used to pay the cost of care during that penalty period. The loan or the note is typically between the Medicaid applicant and a trustworthy child or a trustworthy family member if they have that in their family in order to make a gift to make a loan that they anticipate being paid back to the Medicaid applicant. Not all states are going to recognize a promissory note as an allowable spend down tool. The second option that we could consider would be a gift and return strategy or a partial cure. This is going to require that the client make a large gift, pretty much all of the assets other than $2,000 up front, and they're going to make that gift to a giftee in order to start a penalty period. So in my example, if Mary had $205,000 of excess resources, she's going to gift the whole $205,000 in order to get her total resources under $2,000. Medicaid is going to establish that in this case, Mary would be ineligible for a 20-month time frame, and then each month the giftee is going to pay the nursing home using the Medicaid applicant's income as well as a portion of the gifted funds that are going to be returned by the giftee. So each month that money is returned from the gift back to the Medicaid applicant or used to pay the nursing home, Medicaid should recompute the penalty period based on how much money was ultimately gifted and how much money was returned. This strategy also does not work in all states. Some states require that the total gift amount must be returned in order to cure a penalty. So if you're interested in exploring this option for a client, make sure you would check your Medicaid agency manual and just make sure that your state even allows for a partial cure or a gift in return type of strategy before you would do something like that. What if Mary has a limited life expectancy? So in the first scenario, Mary's family believed that she was going to live for another 10 years. But what if we assume that Mary's family doesn't anticipate that she'll live for more than 10 months? The second option would be to use a standalone Medicaid compliant annuity plan. And in this case, a standalone Medicaid compliant annuity plan is not going to involve any type of gift or transfer by the Medicaid applicant. Instead, we're trying to obtain immediate Medicaid eligibility without gifting any assets. So there's not going to be a private pay or a penalty period in this case. And the whole goal is going to be to obtain immediate Medicaid eligibility and take advantage of the Medicaid rate of, in this case, we'll say it's $8,000 per month versus paying the full private pay rate of $10,000 per month. In this case, because we are not making a wealth transfer or a gift right away, the family is going to obtain a wealth transfer after Mary passes away. In order to establish immediate Medicaid eligibility, we could spend down the $205,000 by purchasing a Medicaid compliant annuity for Mary. Mary would be the annuity owner, the annuitant, and the payee. She would put the full $205,000 into an annuity that's structured over her Medicaid life expectancy. With Mary being 75 years of age, she has a remaining life expectancy of almost 13 years or 155 months. Like we talked about, an annuity can only be structured for a whole number of months. So 155 months is going to be the longest annuity term that we could structure for Mary. If we did the full 155-month time frame, the monthly payment is going to be $1,350 per month. And we see that the total payout at $209,250 is slightly greater than the $205,000 that was used to purchase the annuity contract. The parties to the annuity contract in this case is going to be exactly the same as our first example, where Mary is the annuity owner, she is the annuitant and the payee. It's important to note in this case that the state Medicaid agency, being the primary beneficiary, is going to be more impactful in the second option because Mary is going immediately on to Medicaid, so the state will have a right to recover in the standalone annuity plan, whereas in the first option, since the state was not paying during the private pay period, they did not have a right to recover in that case. So the contingent or secondary beneficiary is going to be the same. It's going to be a child, a trust, a charity, or whoever Mary wants to name as a beneficiary. The advantages of the standalone annuity plan is that we were able to obtain immediate Medicaid eligibility and take advantage of the private pay rate. We're able to take advantage of the fact that Mary is not going to have to privately pay because we are not making a gift in this first example. The second advantage is that we were able to obtain the Medicaid rate, which in this case is going to be $2,000 less than what the private pay rate is. And depending on Mary's longevity, she would potentially make a wealth transfer to her intended heirs after she passes away, assuming there's money left in the Medicaid compliant annuity contract after the state is paid. The disadvantage is the longer Mary lives, then the less money that is going to be available to pass on to her intended heirs, because the state is going to first have a right to recover for however many months they provided Medicaid benefits. So if we anticipate Mary living for an extended period of time, it's going to be better to proceed with the first option, because in that case, we know that we're able to preserve at least around 50% of the assets, whereas in the second scenario, if Mary lives for many years and that income is going towards her cost of care, and then the state also has the right to recover after she passes away, then the contingent or secondary beneficiaries are going to be very limited in how much money they receive out of the Medicaid compliant annuity contract. We also need to consider whether we're working in a state that has rate equalization, where the Medicaid and the private pay rate are going to be exactly the same. If you live in one of those states, then you're likely not going to want to go with option number 2, because there's not a cost savings between Medicaid rate and what the private pay rate is going to be. So which option is going to be better, option 1 or 2? There's many factors that we would take into consideration. The first is obviously the Medicaid applicant's anticipated longevity is going to dictate which plan is better. So in the first example, we had an 11-month time frame that Mary was going to be privately paying. And so if we don't anticipate her living for the 11-month time frame, then it may be better to go with option number 2. We also need to know what the Medicaid reimbursement rate is. Some states publish the Medicaid reimbursement rate on their Medicaid department's website. Other states, you actually have to call the facility to figure out what the reimbursement rate is. Also, we want to consider if we're working in a state that has an actuarially sound requirement for annuities. 3 states that currently have an actuarially sound requirement are Oregon, Washington, and North Dakota. So if you live in one of those 3 states, then the ability to do option number 1, the gift and annuity strategy, may not be an option, because although we have the insurance companies that will do a very short-term annuity in these 3 states, the actuarially sound requirement would not allow for the annuity to be purchased for an 11-month time frame based on what the client's actual age is. Also, we want to consider if the bulk of the Medicaid applicants' assets are invested in pre-tax or IRA dollars. That is a topic that we're going to be talking more about next month when we're talking about planning for an individual client that has IRA or pre-tax accounts. Some of the reasons why you may choose to consider to work with myself and the company Ashford that I created is, like I said, I've been working with attorneys for the last 15 years on Medicaid compliant annuity contracts. We only work with A-rated insurance carriers, and we do assist you with completing or figuring out how much the annuity term should be, how long the annuity term should be, and how much should go into the annuity contract. And we also offer top-notch customer service. We usually get back to you the same day with recommendations or an analysis on different options for your clients. And now I will answer any questions, assuming I still have audio. It looks like some people are still having issues with that. Somebody is asking a question about when should a client consider purchasing a Medicaid compliant annuity? Should they wait until they need to go into a nursing home? Yes, so typically a Medicaid compliant annuity is going to be considered a crisis planning tool, not a proactive or pre-planning tool. So we do typically use it once the client has entered a facility and we're able to gauge how much their cost of care is going to be, and it's done after a person actually enters the facility. The Medicaid compliant annuity is not going to be a great pre-planning tool because it is going to be completely irrevocable and non-assignable. So you don't have a whole lot of flexibility once the annuity is purchased if you're trying to use it in a proactive planning stage. Another question is, when a client purchases a Medicaid compliant annuity, is it considered a gift? As long as the annuity meets the requirements that we talked about as far as being irrevocable, non-assignable, actuarially sound, making equal payments, and naming the state Medicaid agency as a remainder beneficiary, it would not be considered a gift or an uncompensated transfer. But if your client purchases an annuity that does not meet all of those requirements, then it can be problematic for a Medicaid qualification situation. Another question is, somebody is asking, I thought Georgia was an actuarially sound required state. Are the 3 states that you listed the only ones? So Georgia requires that the annuity must be actuarially sound, but they don't have a more restrictive definition of actuarially sound. In all states other than the 3 that I mentioned, as long as the annuity returns the total amount that is put into the annuity plus interest within the person's Medicaid life expectancy, then it's going to meet the actuarially sound requirement. So it can be structured over a shorter period of time than their full Medicaid life expectancy. But in the states that I mentioned, like in North Dakota, the actuarially sound requirement is that the annuity term must be at least 85% of what the actual life expectancy is of the client. So in that case, a shorter time frame of 11 months is not going to work for a client that resides in a state that has a more restrictive definition of actuarially sound. Another question is, if a client has a SPIA already that is not Medicaid compliant, can they convert it into a Medicaid compliant annuity? We're actually going to be talking about this in our December webinar and what options clients have if they already have an immediate annuity. So a short answer is that an immediate annuity, once it is annuitized, it's no longer an asset. It's strictly an income stream. So it would depend if that annuity has non-assignable language in it or not. If it is assignable, we could consider having the annuity purchased by a company like J.G. Wentworth or Peachtree that would purchase the non-Medicaid compliant annuity for a lump sum of cash and then do planning with the cash that the Medicaid applicant would receive as a result of selling that contract. If a client does have a tax deferred annuity that is still a lump sum of cash and it has not been annuitized, then you can consider doing a 1035 exchange into a Medicaid compliant annuity. So there's more flexibility with a deferred annuity than you would have with an immediate annuity. And I think that I have answered most of the questions here. If you still have any questions, you can shoot me an email or give me a call at the phone number that you're seeing on the screen. I'm very sorry for all the audio issues we had throughout today's webinar. Hopefully during the recording, if you missed anything, you can listen to the recording. Also, you can find a copy of the slides either here on the GoToWebinar dashboard or shoot me an email and I'd be happy to share these with you. But if you have any questions, feel free to reach out to me. Thank you all for joining me and I hope you're doing well. Take care.